Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, January 10th, 2025. It's 9:57 a.m. Eastern Time. Just really wanted to get one out to you guys. There is a lot that I'm seeing right now. We're at pretty, in my opinion, a very technically significant juncture in the markets right now, and I'm going to give it to you in a nutshell. Basically, we have that positive divergence I highlighted on the 60-minute chart. We had it last week. We got a bounce out of it. That's right here. This is NQ, the NASDAQ 100 futures. So we had positive divergence at that point. We got a tradable bounce for sure. We're back to that level. Somebody asked me last week, where I would, consider a stop on bounce longs. I said somewhat below that level. That's the recent. You can see now we're back there again. That's about 20,982 on NQ. I'll get to QQQ in a second. And we could go a little bit lower. That's why I said stops would have to be out of range. Usually when they come down and it's a well-watched level, the powers that be, the nefarious forces, whatever you want to call them in the market, will tend to run through there to clear those stops, blow out the stops. Talking about the big firms and trade, the big trading desks that have enough money to be able to briefly move the market, blow out your stops, take your shares, turn around and buy those, and then go long. Now, if that happens, the buy signal really is a recovery back there. A breakdown is a breakdown, but you'll still have divergence on a marginal new low, and that's why I said if you're going to try to game a bounce here, you want to set your stops out of that range. Now, nothing's changed from my longer-term perspective. That hasn't changed. We had some solid sell signals. Recently, we had the bearish engulfing candles on the weekly chart at QQQ. Then we had the breakdown of the trend lines off the, this one goes back to July here, but we had the August 5th lows. And yeah, this is by the way, a 6-month chart with 2-hour candles. So that's it in a nutshell. Let me just tell you how I tend to trade. I'm not a mechanical trader. I'm far from it. I tend to pass on things that might look like attractive short or long setups if other conditions out there. So there's a lot that goes into my analysis, and that's what when somebody asks, what are you thinking on the markets? It depends on what Apple does, what Treasury bonds do, crude oil. I'm going to get to all those in this video. But as far as that, somewhat mechanical thing, it's these divergent lows on the 60-minute chart that much more often than not, especially in a primary uptrend, which we're in, play out for double-digit gains, reversals. And again, they're probably going to try to run it here a little bit, take it out. Now, support is support until it's broken. They can break it. And, this is a big and. If the trend has changed, then what is then more than common is to see 60-minute divergences like this not pan out. In other words, you have divergence, it's a potential setup, and then you break support, you go down lower, and all of a sudden you take out the previous lows in the indicators, you no longer have positive divergence. So certainly something I'm looking for, certainly something I'm open to, not a hard, long, all-in moment by any means. What I do, my job is to highlight objective levels, provide technical analysis, and all I can tell you is that's support right there. It's a pretty decent support level on NQ. And QQQ, it's slightly below. Let's get to that right now. And here's what I'm going to do in this video. I'm going to go through the indexes real quickly, large caps, small caps, hit on a couple of the Mag 8. That's very important. That goes into my analysis here. Apple has broken down. That's very significant. So after going through the indexes and some of the top holdings, I'll quickly talk on treasuries, the metals. Really, it's the miners and palladium and platinum I highlighted for you recently. Usually, a lot of times I'm covering gold, silver, along with GDX, but we've been long GDX now for a couple weeks. Platinum and palladium I threw out to you last week. And then oil and natural gas. So I'm going to try to do it in that order. So that's it. It's let's not overthink it. Again, if you take a mechanical approach, we're at support. It's a support level that just from my experience, they're probably going to run through at minimum. Now, the run through can either be proved to be a whipsaw, and that's it. So if you just want to sit back and wait and see, if you see a recovery, especially if you get any type of intraday selling climax, right now it looks like they're wanting to punch that. You want to see recovery back above that level. That's where it then proves to be a false breakdown, aka bear trap, whipsaw, whatever you want to call it. So that's what it looks like here on that 120-minute chart, 2-hour candles. QQQ, let's go to the 60. Well, this is a 15. I'll start there. I'm going to duplicate that. So again, we keep making these divergent lows, and we keep getting these tradable bounces off there. That ended with a divergent high, came down here. We had 1, 2 consecutive. This is where you have consecutive divergent lows. As long as the indicators keep making higher highs, you get that. So it's one larger divergent low. Each little divergent low, that one, then that one had a little rally, and then the divergence got bigger to this point, expanded, and you had a even bigger rally. And now all this equal or slightly lower low. Again, we can come down here. When does the divergence go away? Again, on the 60-minute chart and on this 15-minute charts, if and when the indicators move down below those levels there. And then it makes a much harder case to go long. In fact, it will actually be a good time, as I mentioned recently, to add to the long-term shorts. If you are, if you are a long-term swing trader, trend trader, or like me, you have different accounts, active trading account. You can go short-term in and out, trade more often, and then long-term accounts, IRAs, or maybe it's a brokerage account that's set aside for swing and trend trading. Then that's what you will trade. All right. So the important things here, I'm going to go over the market-leading Mag 7, Mag 8, whatever you want to call them, stocks. This is the board I've been sharing most recently on QQQ with the primary trend line again off the August 5th lows. Clearly broken. We had a couple whipsaws around Christmas, as I said, to be expected. From my experience, you tend to get a lot of whipsaws around that time, the period between Thanksgiving and really New Year's Day, and we got that. But then once trading resumed, you had a perfect clear breakdown below the level, back test again, everything I've covered before, and that's it. So this is a daily chart right here, and show you we're testing those lows. Let me go down to a 60. On QQQ. Here it is. This is a 60-minute chart. This is the one I gave you today. So right now it is a divergent low, still a divergent low, just like that was. Still will be there. And up to you whether you want to do a hard stop. Again, if you want to even take it, you might be short. There's a lot of reasons to be short this market right now. And we are from a longer-term perspective. This is just trying to gain one last hurrah here if we can get it. If all those things happen today. Stop on a 60-minute close. First candle of the day is only a 30-minute candle, so you can give it to the second candle if you want. The first, I should say the 11 a.m. candle. That's the first full 60-minute candle. And or keep a tighter stop, or don't take it. Maybe you're short and you're going to stay short unless you see a reason not to be anymore. Let me cover the market leaders real quick. Probably the most significant thing I see today is Apple. Apple, it's a busy board. Let me thicken this trend line up, make it clear. This is my daily chart. I've been highlighting this trend line quite a bit. We were at it last week. Let me change the extension color. And that's the primary uptrend line off the April lows right there. Clearly taken out today in Apple, and that is nothing but bearish until and unless Apple can snap back above there. I've been sharing it with you on the 60-minute chart recently as well, same trend line. And so this right there is a breakdown of the most important stock. Well, maybe right up there with NVIDIA. It's larger than NVIDIA, so it has a higher weighting. But you also, as I mentioned recently, and I color coded it for you, we have pretty good support just below at 237.22. So it is do or die time for the market. This is where if this breakdown is going to be a false breakdown, if the NQs or QQQ are going to punch through, make a slight undercut the recent lows, and then reverse, this is where it should happen from. Buyers should step in right now. That was the previous all-time highs on Apple. It broke out, back tested. So from the bearish perspective, if you're looking at glass half empty, you have a solid and clear, unmistakable breakdown of that trend line I've been harping on now for the last couple of weeks, and that is a sell signal. That is nothing but bearish. I repeat, nothing but bearish unless it recovers and we get back above there. So again, if you are going to try to game a bounce long here, nothing heavy at this point in time, or at least keep the stops relatively tight if you go in heavy, or stay short. If you're a swing trend trader, stay short, because this is an additional and a big check mark for that. How I work on check marks. We had a couple in the last few weeks with the bearish engulfing candles on QQQ, then the breakdowns of this trend lines off the recent lows, and now this is a big check mark with Apple breaking down. So, and now if they step in and buy it here, because the way technical analysis works, some folks see the trend line I see. Some folks see this level. Some folks might be looking at Fibonacci retracement levels, or certain moving averages, or candlestick reversals. Doesn't matter, but I can tell you quite a few are seeing this level. And they should, quote unquote, with my little air quotes I'm doing with my fingers right now, the buyers should step in here and buy Apple. If you liked it up there at 260, how do you not love it down here, after a 9% drop at 236? But this is technical analysis. It's a breakdown. It's a sell signal below the trend line. And that trend line is pretty significant, guys. Probably as equally significant, if not more. I'd say a little more than this level here. So that's it. Let's not overthink it. How we close the day is most important. But, if you break intraday, it can open the door to the, you could be down really big by the end of the day. So there's Apple. Let me cover the rest. NVIDIA. I have a new trend line for you, potential trend line I just added today. It's not a great trend line, but it comes off this reaction low there. That was the morning of August 5th when we covered NVIDIA, and all our other shorts there reversed it to long. I've now added a trend line because it comes in the last couple of days. Again, I wish if I had more reactions in the middle, it'd have a little more weighting. But either way, NVIDIA I highlighted as one of my favorites as an objective short here the other day, right at the highs there. Said it was at that equal high, it was a divergent high, and a bearish engulfing candle. One of our subscribers pointed out, thank you, I missed that. So a bearish engulfing candle. So 101 reasons to be short. And if you took that short last week when it was highlighted, you're up already 12%. And again, as I said, it was a topping short. So forget about 12%. I'm looking at 50 to 70% downside on this stock in the next year or so. So take it, trade it that way if you want. If you want to take the quick buck, up to you. We're at trend line support. And so if they rally it here, then that trend line becomes more valid because now you have an additional reaction. And I also have price support just below. So that's one reason that I'm open to a reversal, a little false breakdown today. In a minute, if I get the time, I'll talk fundamentally. The reason for today's drop in the futures is the jobs number. But again, we'll get to that. I don't want to digress right now. I want to cover the charts because that's first and foremost. Microsoft daily chart, as I already mentioned last week, had a breakdown of this uptrend line, the trend line that comes off the early 2023 lows. As I highlighted to you last week, breakdown, backtest, and then as I highlighted on Thursday or Tuesday, we had an impulsive rejection off the backtest of the trend line, and so far now we've undercut that. We're also still in right below the 200-day exponential moving average. That's this red line here. They come in and buy that. It tends to define trends. Microsoft was one of few stocks on August 5th lows that went below there. I had so many other stocks and indexes hitting the 200 days and key support levels, and that's why that morning right there, I acknowledged Microsoft being below, but we covered all shorts, went long, and said that we'll probably come up there, and that was. So that was an outlier, one stock that took out the 200s, but again, so many others bounced off the 200s. But my point is, they're very important moving averages, and so sooner or later they will go, and I think they will go sooner than later. And this one could go today. It's starting to dip below it right now. And what you want to watch, it's not, are you at the moment below it? It's a daily chart. So like I like to say, the redder the better. You look for these daily closes. Once you start clearly losing the 200-day moving average on Microsoft, you can see it right here. This is it. It's so simple, guys, this trend indicator. When you're above it, like you are here, it's bullish. Then when you take it out, like you did there, you're in a bear trend. And when you're in a bear trend, you rally back to the 200s, either the blue or the red line, the simple or exponential, and they sell it. And it keeps the bear trend going until you recover it, like you did right here. And then you buy pullbacks to the 200, right? And then you sell, and the primary trend has changed. And if the primary trend changes in Microsoft, most likely the primary trend has changed or will change in the market. Again, I use this collectively. I look at the Mag 8 or the top 10, and if the majority of them are below their 200-day moving averages, it's pretty safe to say you're in a bear market or early stages of a new trend change. And so watch that level there. All right, well, let's fly through this. I have a lot to cover. Alphabet, GOOGL, there's that uptrend line I gave you recently. Big divergent high. So again, to me, it's a matter of time. Are we going to get one little last hurrah? Alphabet is cracking. We are now currently below that trend line. But the day is young. It's very young. It's 10:13 now. So there's a lot that's going to happen, can and will happen between now and 4 p.m. today. It's a daily chart, so all that matters is how we close here today. Again, the redder the better. Close down here, a lot well below that level. That's a solid breakdown. If we rally back into the close on or above that trend line, then it was just an intraday break and not a sell signal on the daily time frame. All right, but we're right there. And again, the technical posture, to me, it's a matter of, if not more of when than if these levels are going to go. Does it happen today, or do we have a little hurrah into the close today and keep everybody guessing for the weekend? I will certainly do an update towards the end of the day today. Amazon, beautiful uptrend line, comes off that same August 5th lows, hard reverse, cover all shorts, go long there. And again, one of the few that briefly undercut the 200-day moving averages at that uptrend line now. Very well-defined trend line. This is the kind of trend line I like. Distinct reactions throughout. In addition, we have price support. So we have Amazon. Again, this is why I'm doing these top 10 stocks. These are the market. We have it at dual support, trend line and price support. There's a previous reaction high, broke out to new highs right here, back tested it, back testing again. Bulls want to see this, bears want to see that, right? Simple stuff. Meta, uptrend line right here, white uptrend line. I know I have busy boards, got a lot of trend lines, a lot going on here, but I'll just draw it over here. We have a trend line comes off that late October lows right there. Nice, clean reactions along the way, and we're on trend line support. So this is why we may get that one last hurrah. We have a lot of leaders. Apple's broken down today, but the day isn't over. Watch Apple. If it can recover or hits that price support I showed you and bounces, then maybe it goes in and back tests the trend line. Maybe it recovers it. Or it goes the other way. And then that's an additional reason to maybe add to some long-term shorts. Tesla's just kind of hovering there. And again, Tesla, Netflix, a couple of my favorite long-term swing shorts. Broadcom right there, a little minor trend line break right there, but still up in that range here. If, let's say next week you gap down big, you could have an island cluster top in a Broadcom, but right now there's really not much else to add to that. Costco broke down and back testing the trend line. So see, we're getting the bearish evidence continues to mount, and I'm just looking at like picking up nickels in front of a steamroller to see if we can get a bounce here right now, which may or may not come. We'll see. Netflix, again, one of my favorites, highlighted here. We broke down. We've already dropped since the breakdown. That one's profitable about 9%. So if you are trading flexible right now, long, short, long the most bullish things, be it stocks, indexes, sectors, commodities, and then short the most bearish, that's what I'm doing, and it's been, the last couple months have been very good. It's a stock pickers market, we call that. The last couple of years, it was a buy and hold, and everybody thinks buy and hold, that's it. I think there's been a tremendous embedding of herd mentality that all you have to do is buy every dip and hold and buy corrections and bear markets, and I think that's going to lead to one of the biggest bear markets we've seen in probably our lifetime coming up in the coming years. Especially now, I can say it with more conviction because the Fed has completely lost control of long-term rates, lost control of the long end of the yield curve. So Netflix, anyway, that's the next sell signal, that break of 864.29. That's bearish. And again, if the market bounces, they all bounce. Usually they'll all bounce together. But again, we've seen that. Like I want to put that little asterisk in there, that we've seen that kind of disconnect now where some stocks aren't following the indexes as much. There is, again, some more variance now than there has been for quite a while. And so I think it's still a good time to maintain that long-short portfolio. All right, that's enough. If I go down the line here, it doesn't matter anymore because the top 10 move the needle the most. All right, I told you I'd cover the other indexes. Let me move along here. SPY, SPY. I have different boards here. Let me focus on this one. I know it's a busy board. I'm just going to draw out, again, this is that August 5th trend line breakdown, textbook breakdown back test. No whipsaws, no nothing. As I like to see a breakdown, that one right here was very impulsive and clean, so clear a blind man could see it. And then a perfect back test, again, of the trend line off the August 5th lows. And we're moving lower. We do have this trend line right here I gave you. Kind of gives you a megaphone pattern right there. But there's this, I didn't draw it right. This is it right here. So we're at that trend line support. I highlighted this one for you last week. I'll make it nice and fat so you can see it there. So, and there's also a gap right here. Traders love these gaps. So there's a near gap backfill on SPY, and still gives the opportunity here for the bulls to step in. This is a 60-minute chart, just like QQQ, positive divergence. And again, I've been doing this a long time. It's just hard, as longer term bearish as I am, and as many sell signals as I've seen click on the daily and weekly charts recently, I just can't, ignore these 60-minute divergent lows. That's usually all it takes in a bull trend. There was one right there, a little divergent low, and we rallied. Oops, tried to measure it for you. That gave you a 7% pop up to new highs in the S&P. So that's it, guys. Oh, and the support, I already covered the support on the daily. There's the gap right here. And so traders are going to be looking at that gap and saying, oh, there's a gap backfill on SPY. All right. IWM, small caps have broken down. So the small caps, well, we can look at a glass half full, glass half empty. This is a daily chart. There's the primary uptrend line. It comes off the October 2023 lows. I've been highlighting this quite a bit. We've been dancing on it for the last couple weeks. A clear breakdown today, but as I told you last week, we have those, we'll call them, if you're a bear right now, we'll call them pesky little 200-day moving averages. Bulls love them. You buy pullbacks to the 200s. It works until it doesn't work. It's that simple. And so, again, you have a breakdown of the primary trend line. A lot of eyes will see that. A lot of eyes probably shorted that today. But then another set of eyes, those being bullish trade or just simple market agnostic traders like me. I'll go long, short, doesn't matter, whatever the charts tell me. And I can just tell you a lot of traders will buy. This was the 200s right here. Here, I'll turn it all off. You can see IWM. There are choppy periods where you don't put a weighting on 200-day any moving averages when you're grinding around. But when you're trending, this is when we took them out there. They bought pullbacks to them, pullbacks to them, pullbacks to them, and when you're there again. So that's it, guys. So it's a lot going on today. That's why I want to do this video. I know I'm showing you things that are bearish, and I'm showing you, potentially bearish and things that are potentially bullish. Again, my job is to provide analysis. Your job is to decide how to act on that analysis. These are the key levels. And so, yes, there's a breakdown, a clear breakdown of that trend line there, but you're also at price and moving average support. So therefore, I think the odds are still decent today. They step in and buy this thing. And again, I'm going to talk fundamentally in a second as to why I'm giving you now the technical reason why they might buy it. But fundamentally, Treasury still has a divergent low. This is still a indirect hedge to index shorts. Again, longer term index shorts. And if you've done that, then you've been very profitable on those index shorts so far. And any losses on TLT would have been offset by the gains on the index shorts. I still think there's a decent chance, in fact, a very good chance we're going to rally. The charts are still constructive. This is a 60-minute chart. We still very much have. I've been talking about this positive divergence from here. It's not been taken out. So just like the stock market has positive, aka bullish divergence, so does Treasuries. There's that wedge I gave you last week, bullish falling wedge. If we pop it, we're going to go up. If that goes up, that means rates are going to be pulling back and the stock market can rally. Otherwise, we are still, like I said, it's not super simple right now. We're still in my orange zone on IEF. That means rates continue to rise and put pressure on the stock market, as we've been seeing lately. This is the most obvious trade in history, I think. I've been talking about this for all year. Rates go down, stock market starts to take note, really starts to take note, right? It started to take note here. It's where it peaked out when we got my yellow zone. And it really starts to take note, as we've seen lately. We've seen some acceleration to the downside, more and more stocks breaking down. But we're not yet to my red zone. And when we get in the red zone, I will not be interested in gaming counter trend bounces, at least not, for swing trades, maybe for intraday stuff, but that probably won't even make it to the homepage. And that even then, I'd usually just try to, at that point when we hit that kind of all clear short moment, that's where you kind of tuck it away for a while. And so I think, again, the charts are indicating at least at minimum, I think we're going to see a nice short covering rally in Treasury soon, maybe starting today. It'd be a good day for it because everyone thinks, well, God, now Treasuries are never going to go up. Yields are down. Yields will never go down. Treasury bonds are never going to rally because look at today's jobs number, which I'll talk on in 1 second. All right, so that's it. Treasury bonds, again, this is the 10-year, but the 30-year, they all look the same. Big positive divergences. 5 years got some really strong divergences. Let's see. Okay, let's talk about some of the diversified trades we have now. I gave you, before Christmas it was, right here. I gave you a long on GDX and video, said I really liked it. Buy it from the support zone from the top when we hit down to the bottom, but not below. That was our scaling zone. Nothing but net so far. We're up about 9%. I gave you T1. What I'm going to do right now in this video, I'm going to modify this. I'm going to tell you we're at resistance. I noticed this yesterday, and yesterday the markets were closed. I think you guys know that. That's why I didn't post anything. I decided I got a lot of things done, knocked off a lot of errands. This is now T1. I'm doing the video live, so it's not too late. I would never give you a T1 in hindsight if we pulled back and tell you that's a target if it's not, if you didn't have a chance to exit. That is T1 now hit. This is T2, the former T1 level. You have, you can see here, this is the 200-day simple moving average we're at. We took it back there, back tested it successfully. So if you took this trade and you're up 9-10%, either trail stops, take profits, not a bad idea either one. Basically, they'll probably step in, sell it here, maybe consolidate. Maybe that's the end of the run. Who knows? All I can tell you is that's been a nice trade. And then last week I gave you palladium and platinum. I like these two. Stood out so far. Nice coming off that divergent low. Nice move up today. We're up another 2% today. It's been walking up. Remember, this setup was at support, breakout, back test, and still looks good up to that 91-ish level there. And the other one was platinum. I gave you both these two. That was a breakout there, and nothing but green sticks so far since last week. So we're up, nothing big, but coming up to that first target there. So still see some more upside there. And on GDX, if you just if you're not an active trader and you think there's more upside, just raise your stops to protect profits. If you're up 9-10%, even 7-8%, no reason to let a gainer like that turn to a loser. So just raise your stops to at least break even or profitable and let it run. Let's see, that's it. Oil, natural gas. Oil, told you I took a starter position in oil last week. Plan to add to it if it popped up because we had more resistance. Appears to be a blow off top today. Just looking at the 60-minute chart, looking at the advance. And this is a resistance on that 60-minute chart. We also have now some negative divergence. So I added to oil. I'm underwater on it then from starter position, obviously, but I've doubled it up and I'll keep a relatively tight stop. You can see there's probably a trend line here. This is USO. I'm using CL crude futures, but there's that downtrend line off the highs. And oil's really pushing the limits too. This is inflationary. So what's happening now, guys? And I've been longer term bullish for quite a while, and even highlighting recently on the pullbacks, broad-based commodity ETFs. And so what the market's seeing now is they're buying oil, they're buying natural gas, which we're still long. I'll cover that in a second. It still looks good. And they're realizing the risk reward, which I've been saying for a while now, is just infinitely more attractive on commodities than it is equities right now. So equities will kind of trade the zigs and zags. DBC and the other ones I've mentioned. DBC, that's not it. DBC. These are longer term trading vehicles. I keep pointing out these divergent lows. That was a divergent low. You can see my divergence lines down here. And this is DBC, broad-based commodity tracking ETN, which I've made the case when you go to a long-term chart, which is right here. This was a end of the last bull market back in 2008. After the stock market peak, commodities continued to run up. They entered a clear and unmistakable bear market from there, fell, ended here with a divergent low right around when the market bottomed after COVID, in which case I made the case for a new bull market likely. Then firmed that up with a breakout of the primary downtrend line, then a breakout above this major resistance level. We started taking out all the previous highs, and so all along for a couple of years now, or a while, I've been maintaining this was the first leg up, new bull market, first corrective wave with another leg to come. Still need to take out that downtrend line, but we have positive divergence on the weekly charts and the daily charts as well. And there's that downtrend line. So nice advance here in commodities, and that's still a place to be diversified longer term. Natural gas, UNG, also up today. I told you in that recently. Here, let me get to the future. Okay, so the futures, which I put the highest weighting in. This was a level here, 355. Well, I was looking for a breakout. We had a lot of reactions there, a lot of reactions. We broke out. That was at 25% plus up day. So turn around, might as well take some profits there. Game a little short pullback trade. Scale in down to, I give you a gap here. So down to, but not below this level here. That's where things would start to look ugly. We'd take out the trend line and that. Either way, we held the trend line. We held above that level. And then I said what you want to see to add to it would be a break back above, a regain back above that 355 level. And we did. We regained it. And then I said last week in the last update, or this week earlier, what you want to see next is a break above these two previous reaction highs. And that's what we did. We took it out there. And so it still looks good. And so you still can buy pullbacks to the trend line. You can buy pullbacks to 355. But we've had a nice correction. This was correction profit taken from not just the 25% up day, but the big run up from the lows, which is a lot more than that. Natural profit taking. And I think that cleared out a lot of weak-handed longs and probably sucked in some short sellers. And anyways, natural gas still looks good up to my just shy of $5 is where I'd still plan to take profits on the long-term trade. But I micromanage. If you get up like that, you're extremely overbought, up 25% a day. You gotta take some profits and turn around, maybe game a little pullback and then recycle back in. And then if you do that, then you can turn a 55% run into a 80+% return by sidestepping the give backs or turning around and profiting part of those from shorting it and then getting back in at a lower price. Okay, I'll end the video since I'm talking fast and going through the charts quick. This is today's employment numbers. The futures sank on this. Treasury bonds sold off. So you're looking at, they had a consensus range. The consensus was 157,000 new jobs, non-farm payrolls. The number came in at 256, way above even the top of the range there. So very hot, very, so we're in bizarre world now. Back in the day, the market would explode and rally off this. The job market just continues to show resiliency. So that from a fundamental perspective, that's bullish for the economy, right? We know that consumer spending accounts for over 2/3 of GDP. So government can, as they have been, spend all they want. But when the consumer rolls over, that's it. The government spending is dwarfed by consumer spending. So this is the single most important thing for the economy is that job market stays strong. So normally that'd be net bullish for the market. Market went down because we know we're living in a bizarre world. The Fed has destroyed the mechanism of price discovery. The market is addicted, just like a heroin addict. The market's addicted to low rates. So this is a hissy fit that we're not going to get another rate cut. This is just, knocks down the chances of another rate cut at the upcoming meeting. Stronger than expected job numbers, but it's net bullish for the, if the consumer spending, that should help support the economy. Either way, you can see the numbers there. And so that's what happened. Private payrolls up 223,000 versus a consensus of 130. Blew the cover off the ball. average hourly earnings and all that right here. So that's what happened today. If you want to know what happened, so whereas in a normal world that would be bullish for the stock market, it's being treated today as bearish only because it takes the chance of another rate cut off the table. But you may get fund managers, institutions that come in, the pros that say, you know what? Okay, so we're not going to get another rate cut, but the economy is on sound footing. At least the job market is. Now, whatever. I take the government data, especially jobs report, with a massive grain of salt. I'll just say that. But again, those are the numbers, and that's the number that the algos are going to process. So you could see today, again, a nice recovery where they come in and buy stocks for that reason. So again, it starts back to where I started the video. We're at support. Let's not overthink it. I can sit here and talk fundamentals all day, and at times it makes sense why a strong jobs report is bullish for the stock market. And then you can see today why it had a net negative reaction. But I just want to say net, what would you rather have? Weak, economy, a bad jobs number, declining, rising unemployment, more and more people being laid off, not having paychecks to spend on luxuries and discretionary income. Would you rather have that and low rates, or would you rather have strong consumer spending money and higher rates that they're it just, the talk will be, the narrative will be, if the market can rally from here. And again, like I said, it's very precarious. The narrative they're going to spin on bubble TV, they're going to start saying, well, that's, I guess it's the we're back to normalized rates where we were in the past. And we thought that the increase in rates wouldn't impact the consumer. But the consumer, I guess, is just okay with the, where rates are. So if you look at it long term, guys, like this, you look at rates. Again, I'm just telling you where, the media is going to they're going to march pundits out that are going to make their case in hindsight as to why the market's doing something. But here's where we're at on the 10-year bond. The 10-year is the most important. We're at 4.728% right there. You can see this is the yield right here. Take it back over time, which I'm doing here, and you can see we're basically where we were back in 1998 before the dot-com bubble. Back where we were in 01, 02, that's where that bear market ended. We had a bear market from 2000 to 2002. Interest rates are where they were pretty much in the early 2000s there. So we're just back to that point right there. And so, this was all the post-financial crisis. There's a financial crisis where we had artificially low rates, where the Fed started their little shenanigans, zero interest rate policy and quantitative easing, and then in their infinite lack of wisdom, they just figured they could do it forever and just gun the stock market to infinity and beyond by just keeping rates low because there was no signs of inflation. And that worked until it didn't work. And then the cat was out of the bag here, 50-year high inflation. And so they realize now, and now the bond market's saying that they've lost control. And so they're in a pickle now. They tried cutting rates to bring down short-term rates. Long-term rates, and it didn't work. So either way, I just wanted to say that. So we're back to a normal rate environment, I guess is what I'm trying to say, guys. Back to where, at least in recent history. Again, we can go back as far as we want. Remember, we're not in the 70s or the 80s. That's when rates were a lot higher. But we are back to a more, again, in recent history, normalized rates. And so if you want to make that bullish case, now I don't. Long term, nothing's changed my longer term outlook. We know that valuations are at nosebleed levels. Market breadth has deteriorated to levels almost unseen before, with just fewer and fewer stocks holding up the market. The vast majority of stocks either in bear markets or below their key 200-day and 50-day moving averages. So I could sit here and talk on that all day long. I've already covered that. Nothing's changed there. That's why I'm not doing updates on market internals or anything like that. Those things are conditions. They already happened, and they will most likely play out. Again, so what I've done in this video is I kind of told you my short-term outlook, which is I think we'll probably good chance of getting a bounce off these levels today. Come in and buy. If they can close this market green today, we're probably almost certainly going to see some follow through in the coming days to weeks, because those where I started the video, those 60-minute divergences will be firmed up. right here. This is QQQ. And so if we can get a reversal and a green close today, this will be confirmed by a positive divergence right here. And that will most likely send us up to at least this trend line and possibly beyond, guys. Very possibly, because again, if you go back in time, I haven't seen a 60-minute divergent low this big in a while. Maybe here's something I could see. And we'll see one day at a time. We haven't even reversed or closed green yet today. We got to turn around, close green. But if we run up here and we do take out the trend line, which is this kind of wedge type pattern, maybe we go on for a back test. That's going to come close to negating those bearish engulfing candles on the weekly. And it's something, you probably wouldn't want to ride out short if you're an active trader. You'd want to capitalize on long. So let's just say that is certainly a potential target. Maybe it takes out the recent highs by a small amount. If it does, I'm going to tell you right now, we're weeks away. We're so far right now, everybody's looking at the downside. I'm sure everyone's wanting to short today and thinking how bearish it is. But I can tell you right now, any marginal new high anytime soon. This is a weekly chart. Even on the daily, will still be a divergent high. Will not change my outlook. So best case scenario, what I'm saying is maybe we get a back test of the trend line at a slightly higher level and then roll over. And that's it. Otherwise, if they cannot rally it up today and if those divergences get taken out, at minimum we're coming right here, and probably in a relatively short order, we'll come and test the this uptrend line and the 200-day moving averages. That's going to be about, from where we're at now, about another 5.5% below, which probably meshes with. I'll give you some targets recently. QQQ, where are they? Oh no, these are the long-term swing targets. We already hit. Remember, we hit T1, T2, and then I'm still looking for a move down to these additional targets in the coming months. All right, I'm going to wrap it up now. Let's just see where we go. All right, you guys know my thoughts. Current positioning favoring long bounce with stops not far below now today's lows. I gave you that stop. I just covered it on the 60-minute chart of QQQ, and again, that's my plan. All right, guys, I'm going to stop it here. This has been Randy Finney with Right Side of the Chart. Have a great day.